Welcome back to Boni's Life, where we decode the crypto markets with precision and a touch of wisdom. I'm Boni, and today we're diving deep into what September 2025 has in store for crypto traders across all time frames. Whether you're a scalper hunting for quick profits, a swing trader riding the waves, or a long-term investor building generational wealth, this episode is your roadmap through the current market landscape. Let me start with a reality check that might surprise some of you. Bitcoin kicked off September at $108,253, and if you've been following crypto long enough, you know September has earned quite the reputation. Since 2013, Bitcoin has averaged a 3.77% decline during this month, earning it the nickname Red September. But here's where it gets interesting. We're not just dealing with historical patterns anymore. We're navigating a market that's more sophisticated, more institutional, and frankly, more unpredictable than ever before. Right now, as I'm recording this, Bitcoin is trading around $109,000, showing some resilience after that August dip. But before we get too comfortable, let's examine what the data is really telling us. The Fear and Greed Index has been dancing between 39 and 49 over the past few days, oscillating between fear and neutral territory. Now, for those new to this indicator, when we see readings in the 40s, it typically signals that the market is in a state of uncertainty, but not panic. Experienced traders know this is often where opportunities hide. The volume story is particularly fascinating right now. We've seen Bitcoin's 24-hour trading volume spike by 25%, which tells us that despite the fear, there's significant interest and activity. This isn't the kind of dead cat bounce we sometimes see in bear markets. There's real money moving, real decisions being made, and real opportunities emerging for those who know how to read the signs. Let's talk about liquidations, because this is where the rubber meets the road for leverage traders. We're sitting on a potential $735 million liquidation wave if Bitcoin drops below $110,000. That's not just a number. That's a massive amount of forced selling that could create a cascade effect. But here's the flip side. If we hold above these levels, all that potential selling pressure becomes buying pressure as shorts get squeezed. The open interest data is painting an interesting picture too. Bitcoin futures open interest increased by over 1% recently, while we've seen some capital outflows in other major cryptocurrencies. This suggests that institutional money is still betting on Bitcoin even as they are becoming more selective about altcoins. It's a sign of maturation in the market, where Bitcoin is increasingly viewed as the digital gold standard while other cryptocurrencies face more scrutiny. Now, let's address the elephant in the room, the Federal Reserve. Fed Governor Christopher Waller has been quite vocal about supporting a 25 basis point rate cut at the September meeting. Markets are pricing in an 86% probability of this happening. For crypto traders, this is crucial, because lower interest rates typically drive investors toward riskier assets, including cryptocurrencies. But here's where it gets nuanced. The market has already priced in much of this expectation, so the real question is whether the Fed delivers more than expected or disappoints. For our short-term traders operating on daily and weekly timeframes, the current setup presents both opportunities and risks. The technical picture shows Bitcoin testing key support at $108,000 with resistance firmly established at $113,500. We're essentially in a consolidation phase, which can be frustrating for momentum traders, but excellent for range traders who know how to work the boundaries. The Fear and Greed Index sitting in the 40s is actually a contrarian signal for short-term traders. When the market is fearful but not panicking, it often sets up for relief rallies. However, you need to be nimble here. The liquidation clusters above $114,000 mean that any breakout attempt will face significant resistance as leverage positions get unwound. For short-term trading setups, I'm watching for a break above $111,000 with volume confirmation. If we see that, the next target becomes $113,500, but expect heavy selling pressure there. On the downside, a break below $107,500 could trigger that liquidation cascade I mentioned, potentially taking us down to the $105,000 level where longer-term support lies. The volume profile is crucial for short-term traders right now. We need to see sustained volume above the recent average to confirm any directional moves. Without volume, any breakouts are likely to be false signals that trap traders on the wrong side of the market. Moving to our midterm traders who operate on weekly to monthly timeframes, the picture becomes more complex but also more interesting. September's historical weakness is well documented, but we're dealing with a different crypto market than we had in previous years. The institutional adoption, the ETF flows, and the macroeconomic backdrop all create variables that didn't exist in earlier cycles. The key for midterm traders is understanding that we're in a transitional period. The August decline of 6.5% has reset some of the overextended conditions we saw earlier in the year, but it hasn't broken the overall bullish structure. Bitcoin is still up 15.35% year to date, which in traditional markets would be considered excellent performance. Ethereum presents a particularly interesting case for midterm traders. It's sitting just 11% away from its all-time high, and the technical indicators are suggesting potential for a breakout above $5,000. The Ethereum ecosystem continues to evolve with Layer 2 solutions gaining traction and institutional interest growing. For midterm traders, Ethereum might offer better risk-adjusted returns than Bitcoin over the next few months. The altcoin landscape for midterm traders requires careful selection. We're seeing a bifurcation in the market where quality projects with real utility are holding up better than speculative tokens. XRP, despite some bearish sentiment, is showing bullish signs on longer timeframes with Ichimoku cloud support. But remember, altcoin season hasn't fully materialized yet, and that's something midterm traders need to factor into their strategies. For midterm technical setups, I'm looking at the weekly charts for confirmation. Bitcoin needs to hold above the 20-week moving average, currently around $105,000, to maintain its bullish bias. A weekly close below this level would signal a deeper correction might be underway. On the upside, a weekly close above $115,000 would likely trigger the next leg higher toward $125,000. Now, let's shift our focus to long-term investors and traders who think in quarters and years rather than days and weeks. This is where the fundamental analysis becomes paramount and, frankly, where the most significant wealth is typically created in crypto markets. The long-term thesis for cryptocurrency remains intact, and in many ways it's stronger than ever. We're witnessing the early stages of a global monetary transformation. Central banks worldwide are exploring digital currencies. Institutional adoption continues to accelerate, and the infrastructure supporting crypto is becoming more robust every quarter. Bitcoin's role as digital gold is becoming more established, with traditional monetary policy reaching its limits and inflation concerns persisting globally. Bitcoin's fixed supply cap of 21 million coins becomes increasingly attractive. The recent activity from long-term holders, who moved 97,000 Bitcoin in the largest single-day movement of 2025, suggests that even the most patient investors are starting to take some profits. But this isn't necessarily bearish. It's a sign of a maturing market, where early adopters are realizing gains while new institutional money enters. The regulatory landscape, while still evolving, is becoming clearer. The approval of Bitcoin ETFs has opened the floodgates for institutional investment, and we're seeing pension funds, insurance companies, and sovereign wealth funds beginning to allocate to cryptocurrency. This institutional adoption provides a floor of support that didn't exist in previous cycles. For long-term investors, the current price levels represent an interesting entry point. We're not at the euphoric highs where retail FOMO drives prices to unsustainable levels, nor are we in the depths of despair where everything seems hopeless. We're in that sweet spot where fundamentals matter more than sentiment. The technology continues to evolve at a rapid pace. Layer 2 solutions are solving scalability issues. DeFi protocols are becoming more sophisticated and secure, and the integration between traditional finance and crypto is accelerating. These aren't just incremental improvements. They're foundational changes that expand the total addressable market for cryptocurrency. However, long-term investors need to be aware of the risks. Regulatory changes could still impact the market significantly. Central bank digital currencies could compete with cryptocurrencies for adoption. And the technology itself continues to evolve, which means today's leaders might not be tomorrow's winners. Let's talk about the global events that could shape crypto markets in the coming months. The Federal Reserve's monetary policy decisions are obviously crucial, but they're just one piece of a larger puzzle. The European Central Bank is also considering rate cuts, and the Bank of Japan's policies continue to influence global liquidity flows. Geopolitical tensions remain a wild card. Cryptocurrency has proven to be both a safe haven and a risk asset, depending on the nature of the crisis. The ongoing conflicts in various regions, trade tensions between major economies, and the evolving relationship between the US and China all have the potential to impact crypto markets. The upcoming US elections add another layer of complexity. Different political outcomes could lead to vastly different regulatory approaches to cryptocurrency. Some candidates are openly supportive of crypto innovation, while others remain skeptical. The market will likely start pricing in these possibilities as we get closer to election season. Climate concerns and energy usage remain topics of debate, particularly for Bitcoin. While the network has made significant strides in using renewable energy, regulatory pressure around environmental impact could still influence adoption and pricing. Now, let's get practical with trading strategies for each time frame. For short-term traders, the current environment demands flexibility and strict risk management. The volatility is there, but so are the whipsaws that can destroy accounts quickly. My recommended approach for short-term traders is to focus on range trading until we get a clear directional break. Use the $108,000 support and $113,500 resistance as your boundaries. When price approaches these levels, look for reversal signals rather than breakout plays. The liquidation data suggests that breakouts are likely to be met with heavy selling or buying pressure, making them risky plays for short-term traders. Position sizing is crucial in this environment. With potential liquidation cascades lurking, you want to ensure you're not over-leveraged. I'd recommend using no more than 2 to 3 times leverage, and even then, only for experienced traders who understand the risks. For most short-term traders, spot trading with tight stop losses is the safer approach. The Fear and Greed Index can be a useful contrarian indicator for short-term trades. When it dips into the high 30s, it often signals short-term buying opportunities. When it spikes above 60, it's time to be more cautious about long positions. For midterm traders, the strategy should focus on trend following with careful attention to volume confirmation. The weekly charts are your friend here. Look for weekly closes above or below key levels to confirm trend changes. Don't try to catch falling knives or fight strong trends. Diversification becomes more important for midterm traders. While Bitcoin might be the safest play, the real alpha often comes from carefully selected altcoins. Focus on projects with strong fundamentals, active development teams, and real-world utility. Avoid the meme coins and speculative plays unless you're comfortable with potentially losing your entire investment. Dollar cost averaging can be an effective strategy for midterm traders, especially in volatile markets like we're experiencing now. Instead of trying to time the perfect entry, consider scaling into positions over several weeks or months. For long-term investors, the strategy is simpler but requires more patience and conviction. Focus on accumulating quality assets during periods of fear and uncertainty. The current market conditions, with the Fear and Greed Index in the 40s and prices well below recent highs present good accumulation opportunities. Bitcoin should form the core of any long-term crypto portfolio, but don't ignore Ethereum and other established cryptocurrencies with strong use cases. The key is to invest only what you can afford to lose and to have a time horizon of at least 3 to 5 years. Regular rebalancing is important for long-term portfolios. As different cryptocurrencies outperform or underperform, your allocation will drift from your target. Rebalancing forces you to sell high and buy low, which is exactly what you want to do. Let me share some specific technical triggers to watch for in the coming days and weeks. For Bitcoin, a daily close above $111,500 with the volume would signal a potential move toward $115,000. On the downside, a daily close below $107,000 would likely trigger stops and could lead to a test of $105,000. The relative strength index on the daily chart is currently in neutral territory, which means we could see movement in either direction. Watch for divergences between price and RSI, as these often signal trend changes before they become obvious in price action. Volume is absolutely critical right now. Any significant price moves need to be confirmed by above-average volume. Without volume confirmation, treat any breakouts or breakdowns as suspect and likely to reverse. The options market is also providing some interesting signals. Put-call ratios are elevated, suggesting that traders are positioning for downside protection. This could be a contrarian signal if the market doesn't deliver the expected decline. Looking at the broader cryptocurrency market, total market capitalization is holding above key support levels, but it's not showing the strength we'd expect in a healthy bull market. This suggests we're in a consolidation phase that could last several more weeks or even months. The dominance charts are worth watching too. Bitcoin dominance has been relatively stable, which suggests that altcoin season hasn't started yet. When Bitcoin dominance starts declining significantly, it's often a signal that money is flowing into alternative cryptocurrencies. As we wrap up this analysis, let me leave you with some key takeaways. The crypto market is at an inflection point. We're not in a bear market, but we're also not in the euphoric phase of a bull market. We're in that middle ground where skill and patience matter more than luck. The fundamentals for cryptocurrency remain strong, institutional adoption continues, the technology keeps improving, and the macroeconomic environment is generally supportive. However, short-term volatility is likely to persist as the market digests various uncertainties. For traders and investors across all time frames, risk management should be your top priority. The potential for significant moves in either direction is high, and being on the wrong side without proper risk controls can be devastating. Stay informed, stay flexible, and remember that in crypto markets, the only constant is change. What works today might not work tomorrow, so continuous learning and adaptation are essential. The opportunities are there for those who approach the market with discipline, patience, and respect for the risks involved. Whether you're looking for quick profits or building long-term wealth, the key is to match your strategy to your time frame and risk tolerance. That's all for today's deep dive into the crypto markets. Remember to like this video if it provided value, subscribe for more market analysis, and hit that notification bell so you never miss an update. The crypto markets never sleep, and neither does our commitment to bringing you the insights you need to navigate them successfully. Until next time, this is Boni reminding you to trade smart, invest wisely, and always remember that in the world of cryptocurrency, fortune favors the prepared mind. Stay safe out there, and I'll see you in the next episode of Boni's Life.